Hey everyone, it's Spencer Hakimian and welcome back to another episode of What's Moving Your Money. On today's episode, we're going to be talking about President Trump's decision to fire Fed Governor Lisa Cook's subsequent refusal to step down, what this all means for markets, and most importantly, the precedent that this sets in the United States going forward, and how this will continuously impact markets as we progress throughout our lives. So stay tuned and I hope you guys enjoy. So last night, Trump put out a Truth Social post that he was firing Lisa Cook immediately. And the reason that he had given was that she had supposedly partaken in mortgage fraud. Now, these claims are unsubstantiated, but nonetheless, the president used them as reason to relieve her of her duties effective immediately. This puts the Fed in an interesting spot because if the Fed continues to let her stay on as a member of the Fed, and if in the appeals process she loses and it is proven that Trump is allowed to fire her, then this would give Trump legal capacity to potentially fire everyone else on the Fed for breach of duty. So Powell and co. are in a very complicated situation here. On one end, do they protect their monetary independence? Do they protect what is an obvious attack against one of their own? Or do they let her go so as to not open a can of potential legal worms? It is a very good question, and to be honest, it remains to be seen what the Fed will do. They have not spoken publicly yet as to what their plan of action is, but I'm going to be looking forward to that very closely. Another thing that's really worth noting is this is unprecedented. This is the first time in 110 years that a president has fired a member of the Federal Reserve. Now, this comes as Trump has relentlessly attacked the Federal Reserve for what he believes is incorrect monetary policy, and he has relentlessly attacked them for not lowering rates fast enough. The direction here is quite obvious. He wants lower rates, whether it is for the better of the country, for the worse of the country. He wants, during the remaining 3.25 years of his term as president, he wants lower Fed funds rate. Ironically, what he may not be realizing is all this jawboning is causing long end yields to rise. It is not as if long end yields have fallen. Go try and get a mortgage right now. You're going to get quoted in the high 6 or the low 7s depending on your credit score. It is not just the Fed funds that impacts the economy. As a matter of fact, the Fed funds is a rather small overall interest rate point relative to the rest of the entire borrowing spectrum. So it is not as if he can just jawbone the Fed into lowering rates and that will transmit into lowering rates across the curve. In fact, it might even price in some higher inflation premium and it might cause rates to rise, ironically. So it is not a guarantee that this aggressive plan of action will even work out for what Trump is attempting to achieve. So it is curious, but we have to monitor it nonetheless because it moves markets. Now let's get into what impact this decision had on asset markets last night, because the reaction was immediate and it was substantial across the asset universe. So the most immediate reaction was that the dollar plunged on the news. And this is fairly obvious. As we lose monetary credibility as a country, as we have political interference in the monetary process, we get closer and closer to losing reserve status. And if we are on a path towards losing reserve status, remember, this is not an on-off switch. This is a continuum that happens over a very long period of time. But it clearly looks like we're on that path towards losing this status relative to other countries around the world. If this status is lost, the value of the dollar is lower. There's no longer as much need to hold on to dollars as there previously was. And as that happens, the dollar falls. And as I keep covering in prior episodes, this is inflationary. This is actually material to your life. When the dollar falls, your imports become more expensive. When the dollar falls, your vacation overseas becomes more expensive. When the dollar falls, your purchase of commodities becomes more expensive. All of the above becomes more expensive when you have a falling dollar. The next asset that immediately reacted to the news that Lisa Cook was getting fired was gold. And this is just the other end of that same exact puzzle. Dollar falls, commodities rise, right? Dollar falls, gold rises. Gold is a, in theory, finite asset, and Dollars are obviously an infinite asset, and as the dollar weakens or as more dollars are in circulation, gold improves. Gold goes up in value. Remember, it's not that gold is getting better, it's that the dollar is getting worse. So I always consider these two sides of the same trade whenever people ask me. The next thing, which was ironic, really ironic, was that treasuries fell. Long end treasury yields rose, right? The 10-year, the 30-year, all of those rates got more expensive last night on this news. And again, as we lose monetary credibility, the market will begin to assume we will look through inflation and we will continue to leave rates lower to pump nominal growth. And as that happens, right, you have to get a higher yield if you want to borrow to someone, because you have to factor in the risks that you are not going to get paid in real terms at this point. So you can't just look at nominal returns. You have to look at real returns, which is why yields are rising. And finally, equities were roughly flat. Equities are flat because, yes, in the long run, this is bad for asset prices. This is bad for a country's stock market and for its financial market. But in the short run, if you are going to artificially lower monetary policy, if you are going to artificially jawbone the Fed into expanding its balance sheet yet again, then it's nirvana for stocks. It's 2020, it's 2021, it's 2009. It's all over again, right? The side effects come next, but the good stuff is going to come first. So stocks may be pricing in a little bit of that. And again, markets are not ethics machines. Markets are pricing mechanisms. So as these things happen, we'll just have to pay more attention to it. That's all it is. And I just want to end this episode talking about the potential moral hazard of these actions. It's not just this one action. It is the compilation of all the actions of what Trump has done in regards to monetary policy independence in a few months. In politics, I always say, don't think of a decision in the present day. Think of a decision based on if the party you dislike makes that decision in the opposite manner. Would you still support it, therefore? That's how you can get to having an honest opinion. Is this a good idea? Imagine if Gavin Newsom wins in 2028 and in 2029, he comes around and he fires all the right-leaning members of the Federal Reserve and replaces them with left-leaning economists. How would that make people respond? For independents like me, for nonpartisans like me, we'd be angry both times, of course, right? But if you are cheering on this decision because in the short term you believe it is good, or your team, quote unquote, is winning, think about how often control changes in Washington. Every 2 years, every 4 years, you name it. Power changes hands. And once you set a precedent, it is very hard to undo that. Once you set the precedent that the president is allowed to pick who he wants to serve on the central bank during his term, well, you've made that a permanent fixture of politics now. And we are all going to pay a price if we do not have monetary policy independence. Not just you, not just your company, the whole country, the whole world will pay for an America that does not have central bank independence. This is a bad idea, and history will ultimately show that it was a bad idea. But nonetheless, I welcome all your questions and comments, and I'm looking forward to the next time.